Hello, everybody, and welcome to Investing with IBD, sponsored by MarketSmith. Today is February 19th, 2020. I'm your host, Arusha Pierce, and with me today is Andy Swan. He is the founder of LikeFolio. Thanks for being here, Andy.
Yeah, thanks for having me on.
On today's podcast, we are going to talk about the current markets, how social data can help you in your stock analysis, and then we will end the episode with 3 current stocks. So the current market. The market continues to be in an uptrend. We have 2 distribution days on the NASDAQ, 5 on the S&P 500, but the market continues to climb that wall of worry, and more importantly, leading stocks are acting well and hitting new highs. Andy, what are your thoughts on the market?
Yeah, I think you nailed it. It's just very strong and continues to just defy expectations. I think it's almost like the more negativity is in the headlines of the world, the higher the market goes. And
Yeah.
I think there's pretty good reason for that. I think that the economy is strong. There's a lot of wealth being created. And, there's a lot of great companies doing some extremely innovative things. So I think that drives a lot of this. And there's excitement around all of it. Plus, money's pretty cheap.
That's true. And also, the U.S. markets are now like the safe haven, right? It seems like the money's coming from everywhere else, and let's park in the U.S. markets because of that innovation, and also we're not having as many crises as a lot of other parts of the world.
That's right. A lot of inflows.
Yes, exactly. And so you definitely want to make sure you're keeping your watch list fresh. Keep an eye on those leaders, because eventually there's going to be a time for a pullback, and so they're going to set up and give everyone an opportunity to buy more shares or start initial positions. So, Andy, let's get into how you got into investing. You've been doing this for a while now. And so why don't you walk us down the path that led you to starting LikeFolio?
Yeah, so my brother and I have been partners in this since the very beginning. We actually opened our first brokerage account together. We were college roommates.
Oh, wow.
And this was in college. It was 1998, 1999. Markets were popping, like even at the gym, people were watching CNBC rather than anything else. It was just the dot-com boom, and everything was moving, and it was a great way to get involved. And it was really like very exciting, and it made sense to me. The markets did. I understood not necessarily, valuations and things like that, but I understood supply and demand and how companies can participate in growing the economy and that sort of thing. And so there was this new era that made sense to me. I was online a lot. I understood the dot-com boom in the ways that I could.
Yeah.
And so I got very interested in the stock market, started studying it, started trading our money, and really just kind of learned by going. And that, I think, a lot of times people miss that aspect of it. Everything's kind of academic until you have real money on the line, I think, for a lot of people. And it doesn't have to be a lot. We started with a couple grand in a brokerage account, and it was, very real to us and very fun. And, it was just super interesting from the very beginning. In 1998, 1999, it sounds like a long time ago now, but it doesn't feel like it.
No, not at all, because that was the time where I got exposed to the markets too. And it was remarkable how everyone was talking about the stock market at that time. You touched on an interesting concept here about putting real money on the line and the emotions that people feel. A lot of people, especially more analytical people, they want to do all the analysis first before making that move, and it's that paralysis by analysis. But go into a little bit more about just put some money on the line and learn to feel those emotions that come out when you start doing well in the markets and then when you start doing really poorly.
Yeah, I just think that it's really easy to pretend that you're doing something. And it's kind of like I like to make sports analogies all the time because I played basketball, and it's like you can't really read a book on how to shoot a free throw. And eventually you got to step to the line with a crowd around you and with other players on the line, and the score is going to matter. And that changes everything. And all of that stuff that you read goes out the window. And so I think it is important, because probably the most important part of investing, I think, is understanding your own emotions and how they can throw you off track and disrupt a strategy that you might have.
Hmm.
And so until you have those emotions engaged, you really don't know how to control them. And unfortunately, I haven't found anything that really beats a couple of bad losers in terms of teaching lessons in a really quick way.
That's true. Though the market has a great way of humbling all of us.
Yeah.
So after you and your brother started your brokerage account, you started putting real money on the line. What were the next steps that got you more involved and really started, enabling you to become an entrepreneur?
Yeah, well, we had really good success, and a lot of people did at that time because it was the dot-com boom and everything was going up. But we had some unique advantages. We figured out like simple things like real-time quotes and
Yeah.
level 2 quotes and things like that were kind of unique at the time. So we were always looking for that little edge, and we were able to find some and exploit them. And eventually, through the chat rooms and other message boards of the time, had actually built up a little bit of a name for ourselves through what we were posting, both in terms of picks, but more importantly, educationally online. And so about a little ways through law school, about 6 weeks into law school, in fact, I decided this is not for me. I don't necessarily want to work with and surround myself with lawyers for the rest of my life. I really have something good going in the stock market, and people are coming to me constantly, not for my picks, but more for how to get started in that educational component. And so that's when Landon, my brother, and I got together and decided, let's start something where people can actually pay us to help them get started investing. We did that. We eventually turned that into, I think it was the world's first live streaming, content and educational channel
Wow.
for that was going across the internet throughout the market day. And people subscribed to that, and we built that into a nice little business that eventually we sold, and that got us kind of kicked off on the entrepreneurial path.
That's very, very cool. And so now your latest venture and is LikeFolio. Is your brother involved in that one too?
Yeah, we're partners on that as well. This is our third fintech company together, and yeah, we're having a lot of fun with this. The reason that we started LikeFolio kind of goes back to those roots, and it's pivoted since then. But back at the beginning, the idea behind LikeFolio and the name was really we wanted to help people create portfolios based on the companies and products that they actually liked in real life. And so we used social media to figure out what they and their friends were talking about online, and actually created a portfolio based on those products called a LikeFolio. The idea was to get people interested in investing. It didn't take long, though, for us to realize that there was a lot of value in the data itself, and
Hmm.
in figuring out what brands and products people were talking about. We were able to see some really interesting correlations between that data that we saw on social media and upcoming future earnings reports and same-store sales numbers.
Yeah, and I saw you speak in the Traders Expo in Las Vegas back in November, and
Yeah.
it was a really fascinating presentation because for us a lot of times we're looking for stocks that are in strong uptrends. You're looking for the purchase intent in strong uptrends, but
Yep.
the stocks might be getting hit and might be falling off of a lot of people's radars. So that's what I liked about it. It's like, okay, this is another way to get some of those stocks that might have fallen off my radar back on my radar.
Yeah, a great example of that would be, last summer, our great call was on Crocs, the maker of the ugly shoes. And what we saw, that stock had fallen off everybody's radar. It was down around 15 or 16 bucks and really kind of dead money. But what we saw was a massive uptick, and a really pretty fast and accelerating uptick in the number of people talking about buying Crocs and liking Crocs shoes and the new models that they had.
Yeah.
And there was some influencer action behind that. I think Ariana Grande and Justin Bieber were caught in public wearing Crocs and not necessarily paid to do so. And that just started this trend, and Crocs were on a comeback. And we were able to see that through the mining of social media data, well before the stock made the move from, I think, 16 to $40.
Yeah, and in the end, the large concept that we're all looking for here is, that supply and demand, whether you see it in the stock market or in the products that can eventually lead to those rises in stocks.
Yeah, that's it. I mean, I think what everybody's looking for is an edge, right? We don't claim to have the golden goose that produces profits every single time. No one should ever claim that, but what we can provide and what we do, work really hard to discover are those small little edges that can add up to a distinct advantage for the investor over the rest of the market. And once you get that, you start exploiting it over and over, and those what were small gains can start to turn pretty large.
Absolutely. So the markets continue to remain in a strong uptrend, and we're almost done with earnings season. Let's take a quick break, but when we return, we'll go more into this, and we'll talk more about the social data and how it can help you with your investing. Stay tuned. I am here with Scott St. Clair. Scott's one of our senior product coaches at MarketSmith. Now, Scott, there are a ton of publicly traded stocks just on the U.S. I think it's over 5,000 stocks. Who has the time to go through all of these stocks and find the very best ones?
Yeah, most people don't, right? So what you need is a tool like MarketSmith. We have decades of research on what makes a great winning stock. So we've done all the research for you. So we're going to try to highlight those specific stocks with those great data points. So if you're looking for that next great potential big winner, orange stock ideas button, you just click on it and you've got some of the main reports that we use, including the Growth 250.
Yeah, and the Growth 250 is the first list that I go through on the weekends.
Yeah, it's the most popular one, but there are others. There's the Breaking Out Today, Stocks Near a Pivot, and then the Blue Dot list, right, which is very popular. It's going to show you the stocks with the best relative strength. So we've done a lot of the work for you. What you have to do is review these lists. You're going to come up with some of the best ideas in that current market environment.
Perfect. MarketSmith saves you time and makes investment research that much easier. For more information, go to investors.com/podcast2020. Andy Swan is our guest on Investing with IBD, sponsored by MarketSmith. Okay, Andy, let's go over how we can use social data to help us with our stock analysis. And I think maybe the best way to start off is with how Tesla came on your radar, because that was definitely a pretty cool story that I heard back in Vegas when you gave your presentation.
Yeah, back in November, I was a little nervous to give that because Tesla was going through a little bit of a rough patch. It started to move higher at that point, but was widely hated. And I think it's a great opportunity to make clear that what we're doing at LikeFolio has nothing to do with tracking investor chatter about the stock itself. We're not concerned with that at all. In fact, a lot of times we found that can be a contrarian indicator. And rather what we're doing is focused on what consumers are saying about the brands and products that the company makes. And all of that information is, it's publicly available on Twitter. We have a great feed directly from Twitter. We're partners of theirs. And so you can kind of think of it as a real-time consumer poll that runs 24/7, and is looking at the opinions and experiences of people that don't necessarily know that they're being watched. So you can trust the data a little bit. And so with Tesla, what we saw was a really nice spike and very sustained in purchase intent mentions. And so that's what we call it when people are talking about actually making a purchase of the product. They're leasing a Tesla, they're buying one, they've pre-ordered, that sort of thing. And so we saw a really nice sustained acceleration in purchase intent mentions, especially around the Tesla Model 3, which was what Elon Musk had essentially bet the company on.
Right.
And so at that point, we're able to see that consumer demand for this product is extremely high and is growing rapidly at almost kind of an insane pace. What we don't know is whether or not Elon Musk and the company is going to be able to deliver, what their production issues might be, their debt structure, all those types of things still have to come into play. But what we could say with certainty on that stage was that consumer demand for Tesla vehicles, and especially the Model 3, was through the roof. And for me, that's a great starting point when you're looking at a company, especially one with the short interest that Tesla had.
Yes, exactly. And as we know, I mean, probably Tesla was around 350 at that point when you were talking about it. And who could have imagined that it would have gone on the amazing run that it's gone on? But when you are heavily as shorted as Tesla was, the shorts have to learn a lesson too about not fighting the trend.
Yeah, I think, it's kind of one of those, perfect storms in a lot of ways because, you had a huge short interest on the stock that had to come off at some point, and it just seemed like with the data that we had on consumer demand for the products, that at some point the dam was likely to break to the upside. Now, did I see it going to $900? No, but we did think that it had room to run in a very meaningful way over the course of 2 or 3 years. It just happened to happen much faster than that, and a lot of that was due to the the demand that had to come into the stock once it started moving higher, and those shorts started having to cover.
Right, and that's that little bit of an edge that you give, and you get a few of these edges. That can make all the difference in the world, because you take that edge and then you apply it to your own stock strategy and your own setups. And when, whatever stock is actually now buyable for according to your strategy, now you can put that plan into place. So that's what I like about it, is that, okay, here's a little bit more insight that I did not have before.
Yeah, I think that's the whole key. And that's why, most of our clients and most of our revenue, 90% plus comes from institutions and institutional investors who are looking to put this into their formulas and into their processes. And the biggest component here that we can offer is that we can say, hey, I don't know about the debt structure. I don't know about their ability to produce, but what I do know is that the demand has never been higher and is growing at an exponential pace. And that a lot of times is enough, because if you remember back in the summer of 2019 and even into the fall when I was speaking on that stage, there was a lot of chatter online that maybe people weren't going to buy these cars, that they weren't popular enough, that they were sitting on, in the parking lots of the production facilities going unsold. And it was, kind of that ability to tap into social media data that led us to say that's absolutely not true. We know that with a high degree of certainty because the sample size is really nice and the data was very clear in terms of trend.
Yeah, and I definitely remember seeing pictures going through Twitter of these parking lots and all these Model 3s and saying, see, they're not selling any of them. So this is a little bit more objective way to look at the data and see what buyers are actually doing. Now, one other thing that I noticed when I was looking at your site, another trend that's been doing pretty well, and something that you spoke about in November too, is the plant-based trend. And Beyond Meat was one of those that did well, but that trend seems to be getting pretty strong, and I guess I've become a little bit more aware of it too, because I've been trying it a lot more, sticking to and trying to stay away from the meat a little bit more. But I think with the younger generation, stuff like that, it's a lot more popular there, and it just seems to be growing, and your data is picking that up.
Yeah, it is. That's one thing we do look at as well, is not just at the company and product level, but we do look at like these consumer macro trends and what is really trending, in terms of consumer behavior shifts and, switching to a plant-based diet, or at least trying to, like you're talking about. I think the new term might be flexitarian or something like that, where you might have some meat here and there, but you're trying to avoid it. And that is a trend that we saw, really taking off. It started, near the end of 2018, beginning of 2019. It was a huge New Year's resolution at the beginning of 2019. We saw that sort of pop in terms of a trend, and that's the kind of thing that you can just use to say, all right, I don't know what Beyond Meat should be valued at. Thinking back in 2019, I don't know what Beyond Meat should be valued at, but I know that there are enormous cultural tailwinds behind this company, and sometimes that's all it takes in order for a company to ride a wave for quite a while. We see that with the streaming space and the cord cutting space, which I think we've got a couple stocks in the next segment that we'll get into that are based on that. But that's the idea: is can we figure out big cultural shifts in consumer behavior and then tie that off into its impact on specific companies by looking at how the brands and products are doing in the marketplace.
No, that's perfect. Now, one other thing that is very important is finding a strategy that works for you that's most importantly aligned with your personality. We'll talk a little bit about that. You've been doing this for a while, and talk about how you align your strategy with your own personality.
Yeah, this is so important, and I think it's part of the process of having a little bit of real money on the line is figuring out, how your strategy might align with your personality, because it's pretty easy to go by the book until, your own personality starts to get in the way. And I think for me, it was quite a process, right? I had to go through a lot of different ideas and systems, and then finally I've figured out that I like to swing for the fences. I like higher, more risky plays. I like to involve options in doing so in order to kind of get the risk side of it pared down to some reasonable level.
Yeah.
But essentially, my personality is one that I think I'm right. I feel like if I don't get the maximum gain out of being right, I can handle losses really easily. It's not a problem for me. They roll right off of me. And so what has to happen is that I have to maximize the return when my edge does pay off. And so that's just a personality thing. That's the way that I look at it. And so I'm able to create a strategy that says, I'm going to use options. I'm going to use them really smart. I'm going to take as many swings as I can with a high amount of leverage and understand that 45% of the time I'm going to be wrong and lose. But on that 55%, 60% that I'm right, I really want to make a considerable amount more. Now, other people like to win 80% of the time, and there's ways to do that, and a lot of people get very disturbed when they start to lose a little bit of money. And so you just have to understand that about yourself. It takes a little time, but I encourage people to try to figure out a way to balance that risk versus reward, but more importantly, that percentage of losers, because I think the main key for a lot of people is some people can't handle hardly any losers at all. It just really bothers them. And so when you're in that situation, you have to start thinking about putting a bunch of stocks together and a bunch of positions together at once and thinking more long term. But for me, it was a process. I think it's going to be a process for a lot of people, but I do think it's extremely important because there's no such thing as a good strategy if you don't stick to it, and your personality eventually will win out.
Yeah, no, that's great advice there. You always have to make sure that risk-reward ratio is there, right? And you also said another thing. I mean, you've been doing this for a long time too. It's funny. Losses don't bother me at all now. I've just taken so many of them that it's like it's just part of the game, right? It's like it's a numbers game in the end, and then how big the reward you want to get, you're figuring that out too.
Yeah, I mean, what bothers me, it still does bother me when I have, something going that looks like I hit it out of the park and then it reverses and, like too quickly to even capture my profits. I thought it was going to run. Like that still makes me mad.
Yes.
And it's still, I still don't like that. But the idea that I'm down some money doesn't bother me. I do zoom out and look at the longer term and think about how my winning positions are paying off or could multiply. And so I think that's it. I think that's for a lot of people, finding that match between strategy and personality. It takes a little time. It takes some experimentation, and it definitely, I think, takes a little bit of real money on the line in order to figure it out.
Absolutely. So purchase intent with social media can give you a nice edge on your stock analysis and also identify some of those stocks that may have fallen off your radar. And then also remember, know yourself. And that way you can find a strategy that works best for you. Coming up next, we will discuss a number of ideas that are worth looking into. We'll be back. I'm here with Scott St. Clair, and Scott is one of the senior product coaches at MarketSmith. Now, Scott, we've both been doing this for a long time, and we know that investment research takes a lot of time. There's so many factors that you want to look into to try to figure out whether this is a stock to buy or not. Quarterly earnings, huge sales growth. Hey, are institutions buying it? The list goes on and on.
Yeah, it's a common question. I hear it all the time. I don't have time to do this work. So you don't have to spend that much time. If you have a tool like MarketSmith, we do a lot of that work for you. Right there on the chart, earnings, sales, group strength, institutional sponsorship, like you just mentioned.
Right.
It's all there in the chart. So it allows you to make a decision much easier.
Yeah, and the beauty is that we have in-house analysts that go through the SEC filings. They pull out those numbers and they put it right on the MarketSmith chart, and all you have to do is analyze them.
Yeah, I couldn't imagine having to go to the SEC website and look at the income statement, et cetera. That sounds like a lot of work.
Yeah, and that would take hours and hours, and in that time, you can go through hundreds of stocks and find the best ones. So don't miss out on a big winner because you don't have enough time to research it. For more information, go to investors.com/podcast2020. We are back with Andy Swan on Investing with IBD, sponsored by MarketSmith. Okay, Andy, let's talk about a few current stocks. And the first one is Roku. And obviously, Roku is in the middle of this huge cord-cutting trend that you guys are also seeing on LikeFolio.
Yeah, that's what initially got us into Roku and interested in looking at it, was that consumer macro trend of cord cutting, of moving away from cable or traditional TV and streaming programs through devices. And it kept popping up, Roku did, as a product that consumers actually really liked and that bridged the gap between, I know I want to get rid of cable. I know I don't want to be paying all this stuff for content I don't use.
Yep.
I know there's better stuff on my laptop, but really I don't understand how to get that onto my TV. And Roku was the one to step in and do that. And so I think it was about a year ago, the stock was at $40. We loved Roku. Purchase intent, it had pulled back, I think, by 50% or something.
Right.
But purchase intent mentions on LikeFolio were just absolutely going through the roof. And to top it off, consumer happiness levels, which we also measure, that kind of sentiment of the consumer, was also very high, which is honestly pretty rare. Normally when companies see a large purchase intent move to the upside, it means that, there's a lot of demand coming into the products, and a lot of times that gets strained and the consumer experience starts to dwindle.
Okay.
But with Roku, that didn't happen. So we knew that they had a very high quality product. And so it's nice to get into a stock when it has those macro tailwinds of consumer behavior, plus it's a best of breed product that holds up well under growth conditions.
Yeah, and when you guys were seeing that, and really what you're seeing here is a major divergence between the purchase intent and it not being displayed in the stock price. It was around 40 at that point, and it only went up to 170 or so during that current run.
It's pulled back now. It's a 125, but
right.
The thing about it is this cord cutting movement is only gaining steam. And I think a lot of times we get caught up in valuations and, companies. What I've found, through a 22-year career is that best of breed companies that have consumer tailwinds at their back, like the Amazons of the world, like the Googles, the Facebooks, they're expensive for a reason.
Yep.
And they tend to get more expensive over time, and that can last for a really long period of time. And so when I look at Roku, one of the most amazing stats on Roku to me is that currently 30% of all TV viewing time is done via streaming, but only 3% of advertising dollars are going to streaming, right? So that gap has to close, and there's a 10x gap in there. And when you're best of breed like Roku, that's a lot of revenue potentially captured. And so I don't know, is it worth 125? Is it worth 60? Or could you just say this could be worth $500 or $1,000 5 years from now, and it doesn't really matter what it's at today?
Right, and the nice thing about Roku, it's kind of the neutral player too.
Yeah,
it's gonna, it can have Apple on it, Amazon, Disney Plus, everyone, and they're also integrated in a lot of TVs, the TCL TVs, maybe some of the Samsung TVs. I think are integrating it now too. And of course, that customer experience, which is leading to the happiness mentions on your site.
Yeah, I think it's another crazy stat. I think a majority of televisions sold in the United States have Roku built into them.
That's crazy
at this point. Like it's insane. They are the perfect neutral player. They're like, the perfect neutral player for this. And I just think, with the consumer tailwind at their back, I just like it. I think it's something to have in. It's an expensive stock, so you got to be ready for some serious volatility, but the upside could be considerable.
Right, and I think the biggest part of that story is only 3% of the advertising revenue is currently on streaming, which that's gonna obviously close. Now Roku on the MarketSmith charts, it's building a cup with a handle here. It's finding support around the 200-day, and so it is taking some time off after that monster run that it had in 2019. Okay, let's go to the second stock. And this is Canada Goose, ticker symbol GOOS. And what are you guys seeing on this with the purchase intent?
Yeah, so what's cool about this company is, very easy one for us to track because they essentially have one product. It goes by a single brand that is very popular that people tend to talk about when they do buy the product. It's expensive. It's a one-time purchase. It kind of has all of those elements that makes a company really nice for LikeFolio. And to top it off, it's extraordinarily seasonal because they sell very expensive, cold weather friendly jackets and coats.
Yeah.
And so every year around January, around the end of December, we're able to look into LikeFolio purchase intent mentions and just see, all right, how much are people talking about Canada Goose jackets? And from 2015 to 2018, every year that spike in the winter was bigger and bigger and bigger.
Wow.
And then this past 6 months or so, actually 3 months, we've seen that this year's peak, although still much larger than what you see in the fall or spring and of course summer, is considerably lower than in prior years. And so we put out a bearish signal on this. I think the stock was something like 36 or 37 bucks. And what we saw in the last earnings report was very much in line with what we expected to see from the LikeFolio data, and that was a softening of sales. But what's interesting about it, to us at least, going forward, it's been a nice play. I think it's a 20% gainer from a bearish position right now. But I still think there's significantly more to this because the way the company explained their soft sales was blaming it on the coronavirus in China.
Oh, wow.
And to me that just doesn't ring true.
Yeah.
I think it's an easy scapegoat, but we were seeing a softness in consumer demand for Canada Goose coats as early as Black Friday and all the way through. And none of this coronavirus stuff had even hit the radar at that point. So I don't think I don't think Canada Goose is telling the full story. I do think that there is a softening of consumer demand, and they've got a lot to try to overcome over the next year. And so, from a long-term perspective, I think the stock's somewhere right around 30 right now. I could easily see this in the upper teens if we talk again next year at this time.
Yeah, and so there's a softening in the consumer demand, and there's also a softening in demand for the stock. This has been in a very consistent downtrend for quite a while right now. It almost seems like it's been about maybe below the 200-day moving average for a year. Yeah, it's like, so any way you look at it, this has been you don't want to be owning this stock at all. And if you want to bet against it, now that's a different story. But the trend is clearly down here, and it's being backed up by the purchase intent that you guys are seeing.
Yeah, it's just it's a one-trick pony type of company.
Yeah.
Where that one-trick pony is not performing so well anymore.
Yeah, and there are plenty of stocks like this that there are more kind of the faddish kind of they have their runs for a year plus, and then after that they're done. I mean, GoPro immediately comes to mind on that when other competitors come out.
And Crocs, like I talked about Crocs last summer, we got the great run. We got it all the way through the fall. The stock has doubled and then some. And now what we wait for on Crocs is another seasonal development, just like on Canada Goose. We have no edge right now on Crocs. There's nothing going on. But once we start into the warm winter months and we start picking up whether or not, if the teenagers continue to go back out or, the KFC Crocs that just came out, like those are going to be a hit. Like they have some weird stuff that they do, but they bring attention to themselves. So what I'm getting at is Crocs is also seasonal. And so we have to wait for somewhere around the spring to start to see if what we saw last summer can continue into 2020, or if, like Canada Goose, it's a fad whose time has come and gone. So we just have to wait and see on that one. But historically, our data has been very good on it. So I'm excited about seeing what the data shows.
Yeah, exactly. Let's go to the third stock, and this is Adobe. And so what are you guys seeing on this?
Yeah, Adobe, I like. It's something bullish we put out. I think it was somewhere around 300. It's climbed with the market really nicely. I think that it kind of reminds me of Microsoft a bunch of years ago, because what Adobe's done is they've transitioned into this subscription business model. They have a best of breed product lineup in all of their, Photoshop and all of their video editing software, things like that. They have a subscription model that gives them very comfortably recurring revenue. And so what that does is it allows them to kind of take some bets that are moonshots. And one of those bets that we're seeing that I don't think the market's really picked up on, I'm not sure yet if it's going to be a success, is their bet on, again, the streaming ad technology. And so Adobe has built out a really unique, personalized, down to the individual, but still, still anonymous advertising technology that works on Roku.
Wow.
that they can provide to all of their Fortune 500 brand customers. And so I think that, kind of like Microsoft, where they built that subscription revenue base for their core products and then took this moonshot bet on cloud computing, I see the same type of thing happening with Adobe right now, and it's pretty exciting in that they have a great subscription business. The stock and the company's fine just based on their core products alone. But the moonshot that they're taking on streaming ad technology, I think, is one to pay attention to, and that could pay off big for the company.
Yeah, I mean, that's very interesting because there's going to be a big fight for all those advertising dollars on the streaming devices like a Roku.
Yeah.
And that brings up to mind, because another one that I keep an eye on, and I do have shares of, is Trade Desk. Trade Desk is almost that kind of the neutral player versus you don't want to go for Google or Facebook. You want to advertise on Trade Desk for the rest of the internet, as they say. And they're also poised to do well as more streaming ad dollars go in. So that's kind of, I didn't know about Adobe. They could become a pretty big competitor to Trade Desk.
Yeah, they're in there, and I think that there's complementary services for each, because a lot of it's the automated mechanical buying of these ads.
Yeah,
it's very reminiscent of what happened with how Google came onto the scene and kind of disrupted the advertising space online and took everybody from banner ads to search-based and individual-based ads. I think the same thing's happening in streaming, and it's probably too early to call the winners, but the ones that are showing progress right now and that are showing real promise are those Roku's, Trade Desks, and now kind of Adobe with this moonshot play, which I like. If you don't want a pure play, if you want to have something with a little bit more of a diversified revenue stream, Adobe's definitely in the mix.
Yeah, and Adobe broke out of a cup with handle back in mid-December after they reported their earnings. They're up 20% from that, and that's nice about having a diversified mix of revenue streams. This has just been kind of a nice, smooth ride up, not a lot of volatility.
Yeah, and they have, when we look at consumer happiness around Adobe's products, it's off the charts high. So that tells us, when you have that combined with a subscription revenue service, that means you have pricing power.
Yep.
And so anytime Adobe wants to drop a little more money to the bottom line, they have the opportunity to do that. And so that's a nice safety valve for the company going forward, for sure.
That's awesome. So there are a few ideas that are worth looking into and considering adding to your watch list. Thank you, Andy, for joining us today.
Well, thanks for having me. I appreciate it. Love the podcast.
That's it for this week on Investing with IBD, sponsored by MarketSmith. Next week, we will have Basim Nawaz on. He is also known as Trader Stewie on Twitter. So that's it. I'm Arusha Pires, and thanks for listening.